SpaceX went public today, and by the closing bell, it was worth around $2.1 trillion, which makes it, for the first time, a bigger company than Tesla. That single fact rearranges a question Tesla shareholders have lived with for the better part of a decade, and we're going to spend most of today's episode on it. We've also got a major Wall Street analyst putting a hard number on a Tesla-SpaceX merger, a new sales record for the Model Y in Japan, an Elon post about Nvidia worth holding on to, fresh full self-driving updates, and a Federal Reserve meeting next week that matters more to Tesla than to most stocks. This is the Tesla Brief, after the close on June 13th. Welcome to the show. A quick look at the stock. Tesla closed up 1.9% at $406.43, while the Nasdaq added 0.3%, and the S&P 500 rose 0.5%. So Tesla outpaced the broader market today, which is worth noting, because the big fear hanging over the stock this week was that money would rotate out of Tesla and into the new SpaceX shares. Today, at least, that didn't show up in the price. Let's get into why that fear exists in the first place. Start with what happened today, because the scale of it is genuinely hard to overstate. SpaceX completed the largest stock market debut in history. The shares were priced at $135, opened trading at $150, and finished the day at $160.95, up just over 19% from where they started. In that one session, $85 billion worth of stock changed hands. To put that number in perspective, that is more trading in a single day than Apple has done on any day in its 40 years on the public market. By the close, SpaceX was worth roughly $2.1 trillion. Tesla, for comparison, sits at about $1.5 trillion. So as of today, the rocket company is the bigger of Elon Musk's two public businesses. And that ordering is the part that matters for a Tesla shareholder. For years, the Musk story was almost a Tesla story by default. If you believed in Elon, in his knack for doing things people said were impossible, the way you bought into that was by owning Tesla. There wasn't really another option. As of today, there is. There's now a second publicly traded Musk company, and it's bigger. So a Tesla investor has to ask a question they simply didn't have to ask a week ago. When new money decides it wants exposure to Elon, does it go to Tesla or does it go to the new one? There are two honest readings of that question, and they point in opposite directions. The bearish read goes like this. The cash to buy $75 billion of SpaceX has to come from somewhere. And the most natural place for it to come from is exactly the kind of long-horizon, story-driven growth stock that Tesla shareholders already own. Names where you're paying today for cash flows that are years away. One prominent fund manager made this case bluntly this week and pointed at the chart as evidence. Tesla is down about 18% so far this year, while the Nasdaq is up around 11%. In his reading, the squeeze on Tesla may already be happening. The other read is gentler. A widely followed market strategist argued that institutions raising cash to buy into SpaceX is a temporary squeeze, not a top. That the recent winners getting sold to fund the purchase get bought right back once the dust settles. Same event, two interpretations. One says Tesla permanently loses a share of the money that used to flow to it as the only Musk stock. The other says this is a passing rotation. And notice what today's price actually did. Tesla went up, not down, on the very day SpaceX debuted. That's one session, not a trend, but it's a point in favor of the gentler read. Now layer on the bigger question, the one that could make all of this moot. A merger. On CNBC during the debut, Dan Ives at Wedbush put a hard number on something that had been floating around as idle speculation. He said there's better than an 80% chance that Tesla and SpaceX get combined into a single company within the next year. In his words, quote, the groundwork is already in place for both operations to become one organization. Here's why that claim lands now and didn't last month. Until today, SpaceX didn't have a public share price, so talking about merging the two was hand-wavy. You couldn't run the math because one side had no number on it. Now SpaceX has a market value the whole world can see. And the moment both companies have a visible price, a deal becomes something you can actually sketch out on paper. Ives wasn't alone in warming to it. An early SpaceX investor said he'd bet on a merger inside a year, and SpaceX's chief operating officer, Gwynne Shotwell, asked directly about a Tesla tie-up, said it might make Elon's life a little easier, and notably, she didn't dismiss it. The pushback came from that same fund manager, who argued the two businesses have completely different markets and completely different risks, and that sharing the same CEO is not by itself a reason to bolt them together. Elon himself, in a conversation earlier this year, suggested he wasn't focused on a merger right now, but he didn't shut the door either. So what would a merger actually mean for you if you own Tesla? In plain terms, a deal like this would most likely turn your existing Tesla shares into shares of one combined company. So you'd end up owning a slice of both businesses through the stock you already hold. And that is exactly the bet a slice of long-term Tesla holders are making right now. One widely followed retail Tesla investor went on Bloomberg during the debut and explained that she deliberately did not buy SpaceX shares in the offering. Her reasoning? She expects Elon to combine the two companies anyway, which would hand her SpaceX exposure through her Tesla shares without spending a dollar today. That's a real allocation decision, made today, based on a deal that has not been announced. So the fair question is whether it's pure hope or whether there's anything concrete underneath it. And here's the piece the broader chatter keeps skipping. The thesis depends on a specific sequence. SpaceX has to get added to the major stock indexes. That forces index funds to buy it, whether they like it or not, which supports the price. And only once SpaceX has a strong, stable value does a stock-for-stock deal with Tesla become attractive to actually do. The reason this isn't pure speculation anymore, one piece of that sequence happened today. MSCI added SpaceX to its standard and large-cap indexes on its very first trading day, unusually fast. That doesn't confirm the rest of the chain, but it's a concrete, checkable data point, not a vibe. So watch the next few sessions and watch the next round of index decisions. That's where you find out which of these readings was right. Away from the SpaceX noise, there was a genuinely good piece of fundamental news today. Tesla Japan confirmed that the Model Y was the single best-selling imported vehicle in the entire country in May, beating every foreign brand. Tesla registered just under 2,000 cars in Japan that month, nearly 3 times what it did the same month a year ago. For the year so far, it's had about 8,200 registrations, up roughly 157%, which pushed Tesla past Audi into 4th place among all imported brands, behind only Mercedes, BMW, and Volkswagen. For context, Tesla sold around 10,600 cars in all of Japan last year. At this pace, it's on track to roughly double that, possibly reaching 20,000. Two things are driving it. Tesla has been opening showrooms inside high-traffic shopping centers instead of out on the roadside, putting the cars in front of people who weren't shopping for one. And Tokyo just expanded its EV incentives, which, stacked on top of the national subsidies, could cut the effective price of a Model Y by nearly half for buyers who qualify. Now, Japan on its own isn't big enough to move Tesla's global numbers. But it's a useful entry in the ongoing argument over whether demand is genuinely weak everywhere, or whether it just varies a lot by region. In Japan, at least, demand is doing the opposite of weakening. There's also a small but interesting signal from Elon himself today. In the middle of all the SpaceX coverage, Nvidia sent a public congratulations, and Elon replied that he's, quote, looking forward to taking our exciting partnership with Nvidia to the next level. The post isn't an announcement of anything, but the timing is worth holding on to. Tesla has been talking up its own AI chip program, the AI-5 chip, and a manufacturing effort it calls Terafab, which over time is meant to reduce how much Tesla leans on Nvidia's processors. So a simple story had been forming. Musk's empire is quietly moving away from Nvidia. Elon publicly saying he wants to deepen that relationship on SpaceX's biggest day complicates that story. It might mean Tesla and SpaceX are running different compute strategies. It might mean Nvidia stays central to both. There's nothing to act on here. Just file it away for when Tesla's next update on its AI computing plans actually lands. A few quicker items to round things out. On the software side, Tesla pushed out full self-driving version 14.3.4 today. The headline feature is that the Cybertruck finally gets Actually Smart Summon, the trick where you use the phone app to call the truck out of a parking spot, or send it across a lot with nobody inside. Cybertruck was the last vehicle in the lineup still waiting on it. Everything else has had it since late 2024. The update also lets you choose what the car does at the end of a trip and adds a one-tap way to drop in a mid-route stop. None of that moves the thesis, but it's worth noticing the contrast. This is the consumer side of full self-driving, getting nicer parking tricks, while the commercial robotaxi side in Phoenix is still stuck in the mapping phase. Same underlying software family, very different pace, and that gap is exactly what makes the robotaxi story so hard to read right now. On that same software, Tesla also started sending 30-day free trials of supervised full self-driving to owners in Denmark, after the Danish regulator approved it earlier in the week. Denmark is tiny on its own, but it fits a pattern that's been building all year. Tesla's European rollout is happening country by country, regulator by regulator, and each approval widens the base of cars that have the feature. The thing investors are really watching is whether enough of Europe approves in time for this to start showing up as real software revenue this year, which Tesla has hinted is coming. China remains the much bigger unanswered question, and there was no update there. And it's worth saying plainly what we did not get today, because these are normally the two most important sections of any Tesla episode. There was no new movement on the Cybercab or on the commercial robotaxi rollout. The standing position is unchanged. Phoenix has roughly 60 Model Ys staged and is still in the mapping and routing phase with no firm launch date, and the 5 additional cities Tesla had pointed to have quietly slipped from a first-half target to preparations underway. The next thing that would genuinely change that picture is a Phoenix launch with an actual date, or evidence the staged cars are doing real driverless miles with paying riders. Until one of those lands, that story is on the same pause it's been on for weeks. Same goes for Optimus, the humanoid robot. No news today. The version 3 reveal has already slipped from a spring window to in the reporting late 2026, and there's been nothing since. With Optimus being one of the 3 pillars this channel keeps coming back to, alongside Robotaxi and the AI build-out, a quiet week is itself a small data point when the timeline has already moved once. Which brings us to the one dated event that matters most over the next stretch. Next week, the Federal Reserve holds its 2-day meeting, with the rate decision and its updated projections landing Wednesday afternoon, and the press conference right after. Here's why this one is louder for Tesla than for most stocks. Tesla is a high-swing, long-horizon growth stock. Most of what it's worth sits in cash flows that are years out, from Robotaxi, from Optimus, from full self-driving. The further out the payoff, the more its value depends on where interest rates are expected to go, because higher rates make money you'll earn far in the future worth less today. And Tesla has historically moved about 1.8 times as hard as the broader market, in either direction. So the real question on Wednesday isn't just the rate itself. It's whether the Fed's updated projections still point to the interest rate cuts the market is counting on next year, or whether they walk those back. If the message signals more support for raising interest rates than expected, long-horizon names like Tesla tend to take the brunt of it. If it leans more toward cutting interest rates, the opposite. And it all lands on a market that just absorbed a $75 billion IPO this week. That's the thing to watch. That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.